This is the Alhambra Investments Weekly Market Pulse, where we take a look at our observations from last week. Joe Calhoun is here. And Joe, in your report this week, you wrote what I have heard you say many, many times. Our job is not to predict the future. Our job is to interpret the present. And I think there's a lot of that going on right now.
Well, look, everybody wants me to tell them what's going to happen tomorrow, and I keep telling them I can't do that. And people in this business, tend to gravitate towards people who are willing to say, oh, this is what's going to happen. Of course, track record is what it is, and some people continue to watch and listen to people who have been wrong consistently, over the years. I think there's this old saying about, you can make a prediction, but don't put a date on it or something like that. I don't like making predictions. There's no way you can know how things are going to change tomorrow. Policy could change, attitudes can change. Yeah, it's just a waste of time. Just try to figure out exactly how things are right now, which, by the way, right now, things are pretty good. I think people are kind of missing that, trying to figure out how things are going to go bad, and they're missing the fact that things are pretty good right now.
Well, one of the things that you also said in there is if you want to know more accurately what's going to happen, look at the markets instead of the talking heads. And last week, Fed Chairman Jerome Powell said they were probably going to raise rates in 2023, but that's not what the market's telling you right now.
Well, no, and actually it's even more interesting than that, because Jerome Powell didn't really say that they might raise rates in 2023. It was really the dot plot. And actually, it's kind of funny because in the press conference, he essentially said, yeah, you shouldn't pay attention to that. So who knows what the Fed, and as I said last week, look, the Fed doesn't know what they're going to do with rates because they don't know what's going to happen to the economy. They can't know any more about the future than we do. But look, right now, if you look at the 2-year note, the one-year bill, and 6-month bill, 3-month bill, and you work all this stuff out, it's pretty obvious that a year from now, the market's looking for short-term rates to be significantly higher. I would say it's somewhere between 1 and 2 rate hikes between now and this time next year. Probably 1. You got to taper first. That's going to take some time. But look, that's what the market says. And it's kind of interesting to me because the market reacted very negatively to the idea that what the Fed was saying, but the reality of the market doing what it's doing doesn't seem to have an impact at all. And I think that just goes to show you it's what people pay attention to that matters. It doesn't matter what we know or what we believe or what we think. It matters what the majority believes and thinks. And sometimes they just don't pay attention. So it's our job to kind of figure out where the truth lies versus what the market or what the majority believes.
All right, so the market's saying that about potential interest rate hikes over the next year. Our best indicator for growth is the CFNAI. What's it telling us right now?
Well, it's telling us really the 3-month average is 0.81. It's a big number. Look, there's some idea that this is distorted because of various government programs. You had another stimulus passed here over the last few months, so you got these checks out, but that was a couple of months ago. The 3-month average at 0.81, if you get outside of the COVID plunge and response and recovery, you got to go back to 1984 to find a number that high on a 3-month average. That's significant to me. The economy's growing above trend. Look, I've said all along, I don't expect a boom out of this, and I don't think that 0.81 probably will stick around, but I don't know that. Maybe things pull in here, maybe they don't. I can't predict the future. I don't know how all these things interact and what the effect will be, the overall effect. I can tell you that right now the economy is growing above trend, significantly above trend. How that goes in the future, how that changes, I can't tell you. The market actually seems to be saying it's going to continue. That's why they're looking for rate hikes. Look, if the economy was terrible, the market would not be pricing in rate hikes. So I tend to think that, that's the way things are right now. That's all we can really know. And we should acknowledge that. And we'll adjust as the indicators adjust. That's all you can really do.
One of the things that you mentioned in there was that housing is starting to slow. What are you seeing in there?
Well, it's going to be interesting this quarter when we look at GDP to see if residential investment actually adds to GDP or subtracts. My guess is it's going to subtract because we haven't seen new home building. New home building has fallen off. And the same is true. Existing home sales and new home sales last week were down. They've been down the last few months. Look, I think prices just got too high. There's only so much help that you get from interest rates from low rates, and rates have been creeping a little bit higher, but that's not significant. But the point is that, prices go up, and this is what happens. I don't know why people seem to forget this. It's supply and demand. The price goes up, people want less of it. And so I think until you see some either some income gains, more income gains, or you see prices come off a little bit or something, then I don't think you're going to see a big jump in housing activity. Look, we're starting to see some inventory creep in. Some people that have been sitting on the sidelines, kind of waiting, thinking they were going to wait for the peak and put their house on the market. I think they're starting to do it. So how that affects prices, I don't know if it's actually going to knock prices down, but it seems to have stopped them from going up. We'll get a Case-Shiller report soon, and we'll see how that goes. But look, the numbers have been big, 12, 13% gains year over year. That's going to moderate, though, I think, because sales are starting to soften. So demand weakens, and you'll see prices respond, I think.
In the stock market, is value the trend now instead of growth?
Well, look, I still think that I think there's a correlation here between the yield curve and value versus growth. And what it really is about economic recovery. The value stuff tends to be more cyclical. So as the economy recovers, the cyclical stuff outperforms. That's the value side of the equation. It's financials, it's materials, things like that. So look, if we're right, if the market is right about what's going to happen with rate hikes, that means that probably the yield curve is going to steepen, because we've already priced in on the short end. And if economic activity does continue to go at this rate, then the long end is going to have to go up too. If you get a steepening yield curve, then value is probably going to outperform. It's obviously positive for financials. I think that, based on history, recent history anyway, the last three recessions, you would expect the yield curve to peak somewhere between 2 and 2.5% between the 10-year and the 2-year. We're 1.5%. And look, there's precedent. If you go back to the 70s and 80s, early 80s, even the mid 80s, you could see a yield curve peaking at 1.5%. Maybe that's true, but I don't think so. I think we will get a steeper curve, and if we do, then value is the place to be. We remain overweight value. I think there's more, even if you just revert to the previous trend, where value is in a downtrend versus growth. We're not even to the downtrend line yet. So even if that's all we're going to get, there's more to go.
Now, we have had a pullback in stocks, and you expected that, but this one wasn't as deep as you thought it was going to be.
It's typical of bull markets, Bob. When you're in a bull trend, you're in a rising market, corrections tend to be shallow and quick. I don't know that that's all there was to it. There may be more. I can't predict that. What I can tell you is that the market seems to be very, very resilient here. There are people that want to buy this market. Now, look, I think it's expensive, but I can't tell you what earnings are going to do. I suspect that they're going to be good. I think they're going to be good. The estimates all say they're going to be good. Maybe they will be. And if they are, then maybe stocks aren't as expensive as they appear by looking in the rearview mirror. All I can tell you is that there is demand for stocks here.
Last thing today, we made some portfolio changes last week. What are the general moves that we made?
Well, we added a few stocks. We didn't make any big moves on overall asset allocation. There was nothing done there, but we had raised some cash in our individual stock portfolio. So we added 3 names that we've been watching for quite a long time, names that I really like. Listen, I'm a big believer that you want to buy brand names when they're out of favor. Sometimes in this case, we bought one that's kind of in favor, but we bought 3 stocks, an automobile company that I think is a little bit under the radar. People don't really think of it when they think of automakers. That's Subaru. And if you know people that own Subarus, particularly up in the Northeast is where I'm familiar with, but anywhere you see these owners, they are absolutely cult-like. They love these things. And I love companies like that, where they get this brand loyalty. The second one we bought was another one with great brand loyalty. It's a newer company for sure, Chewy. They sell pet supplies online. And this is a company that is really killing it with customer service. It's obvious that the people started this company, and a lot of the people that work there love animals. You see these stories repeatedly now recently where, I saw one recently where a girl called in and said, look, my dog has passed away. I need to stop these these dog food deliveries. Well, 2 days later, she got her sympathy card from Chewy. That's a big deal to people to have pets. And the third company we chose was Viacom. Viacom is a company I've liked from a content standpoint for a long time. They've always had management problems. Sumner Redstone's daughter has been running the company. They combined, obviously, CBS and Viacom. But I think they're finally getting out of their own way. And I think you might finally see this content really monetized in a way that benefits shareholders rather than just Sari Redstone. We'll see how that goes. Look, I added these names because they're things I've wanted to own. They're not expensive. Chewy's not cheap. I'll admit that. It's more of a growth stock than I usually do, but I love the company, and sometimes that's enough. So yeah, look, we didn't make any big changes on the accounts that don't own individual stocks, which is a good chunk of them. They didn't see any changes at all last week. But for the people who have individual stocks as part of their portfolio, we did add a few things last week. We're looking at some other areas for the other portfolios, the ETF portfolios too. Pharmaceuticals look attractive to us. We already own the biotech index, the biotech ETF. We're looking at adding pharmaceuticals, although it's somewhat redundant, but we continue to see a lot of good news out of the biotech and pharmaceutical sector. This is an area of the economy that continues to see innovation. It's an area that continues to see research and development spend. I just think it's one of the most interesting places, and the stocks are not expensive. Everybody looks at technology and they think, technology like computers, but you know what? Biotech and pharmaceuticals, that's a lot of technology too. And it is really, I think, the most interesting area right now in the market.